Hello again, everyone. Welcome to today's session, and thank you so much for joining us. I'm excited to introduce our speaker for this session, Ina Rosputnia, who is the author of Basic Instinct of Trader. She's also the CEO of ManagedAccountIR.com. To our viewers, please type any questions you have in the live chat box, time permitting. Ina will answer your questions at the end of the presentation. With that being said, thank you so much, Ina, for joining us today. The floor is all yours.
Thank you, Aya, for presentation, and thank you everyone for coming to see my today's presentation today, right asset at the right time. I would like to start my today's presentation with the words of Warren Buffett.
Hey, Ina, sorry to interrupt. Don't forget to screen share again.
Okay, I think it was off. Give me a minute. Can you see it now?
Yes, that's perfect.
Okay, great. Thank you. So I would like to start my today's presentation with the words of greatest investor ever, Warren Buffett. Diversification is the protection against ignorance. It makes little sense if you know what you are doing. I can't find better words because certainly diversification matters, but sometimes we are that focused on being widely diversified among different asset classes that we forget about simple basics. By that, I mean there is a time to be in the stocks, there is a time to be in gold, and there is a time for bonds, and it's never the same time. So for this reason, the general style of diversification seems not so good for the investors in terms of returns. It's always better to focus on what asset is the best to own right now. And it's worth to consider that for both short-term, middle-term, and long-term investors. So here's an example of average returns of well-balanced portfolios, old school versus new age school. And you can see that here on the first group, we have the basic balanced model, which is 40% invested in bonds and 60%, and 60% invested in stock market. But there is a problem with that, as you can see from analyzed return. And now have a look at new age portfolio, which is the way more diversified, but look at result, almost the same. So it seems like the modern school of management is more diversified, more aggressive sometimes, but still the results are almost the same. And that proves that why diversification is not the key here. And it's not always that helpful. Certainly, if you are a stock investor, you want to be in the stocks from different sectors, and that is very smart move. But when it comes to diversification between different asset classes, you have to treat it absolutely different way. And first of all, to think about what is better to own right now instead of blind diversification between just multiple asset classes. So what is the most popular assets to diversify your portfolio? Usually it's a gold and bonds. And very often we think about gold as the hedge against inflation, deflation, and recession. In most cases, and especially when it comes to long-term investing, people treat gold this way. But is it the right way to do so? Is it a profitable way to do so? Let's try to find out. So this chart has been taken from Federal Reserve Bank of St. Louis, and they have the same data for different periods. So you can Google it and see any period you would like. It's absolutely free. So the red line is inflation rate, and the yellow line is the price of gold. So as you can see from here, when we have period of high inflation, usually gold peaks. Which means if you have high inflation and if you are in this environment right now and you try to hedge against rising inflation with the gold, likely you will end up in losses with that hedge, because as we see from historical data, it hasn't been profitable year by year. And the only is from this chart, the best way to hedge with gold has been during the period of deflation. But there is a trick about it as well. We didn't have that much periods of deflation in our history. So I don't think that the data about how gold reacts on deflation is that trustworthy. We had a lot of periods of high inflation in the economy, and that's why we have a better view and more trustworthy data, historical data. But in the case of deflation, it's absolutely different, and it takes a lot of more studies. So what about recession? That is one of the most popular topics right now, that recession is coming and everyone should be buying gold to hedge against the recession. But let's have a look at this chart. What we see here, the gray vertical lines, is the period of recession. And surprisingly, as you can see, the recession, at least the beginning of recession, is bearish for gold. That is really big surprise, because most of investors believe that it's time to buy gold if recession has begun, but it's not, as we see from historical data. But later, almost till the end of recession or so, we have a good buying opportunity in the gold market. And you can see the multiple examples here, and each time we see the same picture. We see the decline at the beginning of recession in gold prices, and we see the gold prices bottoming in the middle, or more like this, closer to the end of recession. So this is another thing for long-term investors when it comes to diversification in different asset classes. I know that it might be shocking, because we all consider that it should be different way around. If we are in a high inflation, the stocks should be weak and the gold should rally, but historical data tell us absolutely different, and we want to listen to that because it has been proven by time to be so. So if gold is not a hedge, then what is that? I believe that we have to treat gold as the commodity and safe haven. And when I say the safe haven, I mean absolutely different thing from hedge, because the safe haven is usually not related to inflation or recession, but more to some shorter term economic events and some shorter term political events. So the fair question would be to ask, when and how do we know that gold should be treated and considered a safe haven right now? And we have an answer to that from Commitment of Trader report, and I have mentioned many times previously that it's a great tool for gold traders, because by default commercials are hedgers and they own physical gold, and commercials include also central banks, depositories, and so on. So they own physical gold, or they hold it, and they want to hedge their risk against falling price. And that's why by default they are short in this market. So what happens when we see that they decrease their hedging positions and their positions, short positions, are now close to zero? In other words, it gives us an insight that they're extremely bullish about the gold, and that's why they decided to release their hedge. So just think about it. We have a great, at some point, it may be even considered as insider information. We have a great insight from the biggest players, including central banks, about the gold price. So the next time you will see gold positions of commercials in gold close to zero, then it's time to look for the longs in this market. Are stocks still good investments? And that is very fair question because of what is happening with the yield curve, because of war in Ukraine and a lot of other worries, but let's take it step by step. So first of all, I would like to pay attention to this annual forecast, and it's an average of seasonal forecast, an average of intermarket forecast, nature cycles, and presidential cycles. So this is the average of these few cycles. And as you can see, it suggests that from the third quarter, we will see a lot of strength in the stock market. So the fair question is, what is special about that third quarter? Why it's so important, and why 4 cycles point to that third quarter, not only one, but all 4. And there is an answer to that. In most cases, inflation has been very, very cyclical. And the cyclical top for inflation comes somewhere during the third quarter. And that's why it's so important, because when we see the rollover in inflation, we are usually very, very close to significant bottom in the stock market. So if during the third quarter we will see the rollover in inflation and any other tools you are using will confirm the buy signal, potentially we will have a very, very good entry in the stock market, and we will see new highs at the end of this year. But it's still only the forecast, and we have to wait for the inflation to roll over. And this is the yield curve, one of the examples. From the past, we have seen the yield curve be negative for a very long time, but I want to pay attention that stock market has rallied during that period. And you can take all the historical data from the negative and declining yield curve, and you will notice that always it takes around from 1 to 3 years for the stock market to decline, which means the yield curve itself, what we have right now, is very negative for the stock market. It's true, but it doesn't have an immediate effect on it. And this is the case. And in most cases, we see quite strong rally before any recession happens. What I'm trying to tell is, despite the yield curve is declining right now, it doesn't mean that you have to worry or to short the stock market and close all your long positions right now, because it might take another year or even 3 years for the stock market to top or to enter, or for the economy to enter into recession. Sometimes it works, sometimes it doesn't, but based on all the historical data, it's what we have in most cases when it comes to the yield curve. But personally, I like different approach to yield curve, and you can find this chart also on Federal Reserve website. A bit different way to analyze yield curve. It seems like when it goes below 0, when we have readings below 0, it's very negative for the stock market. But as you can see, it has been far and far from when a recession starts. That confirms what I just told you, that it takes from 1 year to 3 years for recession to start after yield curve went down. So how can we get a better timing from this yield curve? It's quite simple. Just pay attention. Then when we went below 0, and then the line came back above 0.5, we were almost at the beginning of recession. So this is when we have to expect recession, not when the data on this chart goes below 0. But when it goes to 0.5 after being below 0, because it's really, really getting very close, just weeks or month below before the recession starts. So keep that in mind. I think it's very useful for the stock traders and for the stock investors. This is another very useful data from a Federal Reserve, Fed funds effective rate. And when we see Fed funds effective rate being rising and then falling for some time, and it usually also takes around 1 or 2, 3 years, for this pattern to develop. So when it has been rising and then falling, we might be very close to the recession. It's not the best indicator. I believe that the previous chart is more reliable, but if you combine both of them, you will get better timing about recession. So if you want more detailed view on recession, you can have a look at one of my previous presentations here on Money Show. I was talking about other economic indicators that tell us about recession or end of the recession. So when to be in the bond market, another fair question. Generally speaking, but it's very generally speaking, when the yield curve is above 2%, look for bullish setups in bonds. It doesn't mean that you have to jump right away and buy bonds, but at least it's time when you might consider diversification of your portfolio with the bonds. Other than that, I don't think that bonds is effective diversification. I have previously also talked on Money Show about agriculture sector that is very underestimated between the traders and investors and present a very good money-making opportunity. So I believe that nowadays investors should consider diversification with agriculture sector. So now about the tool. It's not actually the tool, but about the approach that will be very useful for you as a trader, as an investor, not depending what instrument you like to trade or invest into, not depending on the time frame you are using. It works on all the markets and on all the time frames. So this is very, very simple approach. You simply connect all the short-term highs and short-term lows. If some of you don't know what is that, the short-term high is the high with two highs lower than it on both sides of it, okay? And the opposite works for the short-term lows. And your chart will be looking like this. And the next what you do is you look for the middle term low and the middle term highs on your chart. So what is the middle term high? Is the high on with lower highs on both sides of it. So this I have on this chart, I have the blue lines that connect short-term highs and lows, and the magenta lines that connect middle-term highs and lows. So when we are using this approach, we can be very clear about the trend. What trend do we have right now? As you can see from this chart, we are clearly in a downtrend. Despite the price action by itself looks like we are in the flat market, but in fact we are not. We are in a downtrend. How we know that? Because each next of our middle term highs is lower than the previous one. And the best entry in the market, if you are using this approach, is to sell during the second lower high within short-term high, middle term high. Once again, the best point to sell in the market is during the second lower high within middle term high pattern. This is exactly what you see on this chart. Quite easy approach. It doesn't require any indicators, any subscriptions or something like that. It's very easy to use, and you spend just a few minutes just putting everything together on your chart and getting clear about short-term direction and about middle-term direction. We have few minutes left to answer the questions, if any. And if you are interested to learn more about any of these approaches, you can visit my blog where I share market commentary and also educational stuff.
Thank you so much, Ina, for your time today. I am just waiting There seems to be a little bit of a delay for the questions to come in. So if you want to keep presenting, go ahead, and then I'll let you know when I can see the questions on my end.
Okay, great. Just to summarize, I would like to add that the classical approach of diversification between the stocks and bond market and gold didn't prove to work so well. So that's why we have to be looking for another ways that work better nowadays and in modern markets. But it doesn't mean that you just have to be widely diversified. It's a very, very wrong approach to think so and to do so. You always have to be focused on what asset is the best one and trying to analyze where money flowing and why you believe the money are flowing into any particular market. What makes this market so attractive for the other investors and why you believe that this sector or this asset will be better than any other.
Hey, Ina, so I did get a couple of questions. The first one that I have is from William. He's asking, do you like the energy sector?
I do like when it has a very good setup, and I also like the energy stocks. So in most cases, when it comes to energies, I trade either stocks or invest into them or futures. And there are some very good tools for these markets. For example, valuation works very well there. It's very cyclical. So you can use natural cycles and intermarket focus, which is another way and another type of cycles, but it's also very effective on energy sectors. Intermarket focus is not so effective on other commodities, even on gold market, but on energies, it works really well.
Well, to follow up that, Eddie's asking, when do you exit the energy sector?
In most cases, when I reach my target or when I get opposite signal. And also there's an extra exit for me is if I am long and I see that market is losing accumulation by professional traders, that is the signal number one for me to add very tight trailing stop or just to get out of the market. Because what I noticed in energy sectors, well, actually in other sectors as well, but in energy, it's more pronounced, I would say, the presence of professional traders and their accumulation. It gives such a great insight, and especially if you are a short-term trader and you like to hold your position for a few days to get a good risk-reward ratio, then accumulation by professional traders is certainly the tool you have to add. It gives just a great insight of when to enter and also when to exit from your position.
My next question is from John, and he is wondering where you see interest rates headed in 1 to 5 years.
Well, it's very difficult to talk about 5 years right now, but I believe that if we will see next increases in interest rates, it won't be that high. So we are somewhere close to the interest rates that will hold for a few years. Doesn't mean that exactly this current interest rate, but it won't be much higher or much lower than that.
And Raymond's asking, what is the right asset at this time?
Well, I usually do my research each weekend to see all the coming opportunities. And at the moment, I don't see like really great opportunity to tell you this is one you want to be in. But I have a warning signal for those of you who are still short Japanese yen. Because all the tools I am using are telling that we are very, very close to the end of this downtrend. And the next what we will see in Japanese yen is either the strong pullback or maybe even the trend reversal. I am not ready to forecast yet because there's not enough data, but if you are short Japanese yen, then consider profit booking very soon. There are multiple reasons why Japanese yen fell that much and why potentially it will bottom very soon. The main reason is the increase of the prices in commodities and energies. And you know that Japanese doesn't have much of that in their country, so almost all of the commodities and energies are imported, and that's why we saw that sharp decline in Japanese yen. But when it comes to ADX studies, cycles, valuation, commitment of trader report, everything is telling that we are close to end of the trend. But I am not ready to say that you have to jump in and to buy yen right now. Potentially in a few weeks, I will get some clearer view about that.
And my next question is from Eric. He's asking, so did your stats show to avoid gold right now?
My stats show that we don't have any clear direction in the gold right now. I can't say you to buy it or to sell it as well. Likely we will see at least few more weeks of this choppy trading. And then in a few weeks, maybe we will get some setup based on the studies I am using. But at the moment, it's absolutely neutral for me. So I don't want to play guessing and just to tell it will rise or it will fall. For me, it's very choppy. This week, next week, maybe we will get some insight from commitment of trader report after this week or something else. But at the moment, it's neutral for me.
And Joel is asking, he's basically saying some Elliott wave experts say that we are in a bear market and others say it's just a correction in the bull market. What are your views on that?
Well, we don't have any sign of bear market, and based on the historical data, we have never had bear market without a recession. We are not in recession right now, which means we can't be at the beginning of bear market. If we will get signs of recession, then yes, we can talk about bear market. But at the moment, I believe it's a pullback of the bull market, at least based on all the economic data and economic indicators we have right now. And as I mentioned, 4 cycles come at the same time in the stock market this autumn and point great buying opportunity. So if this autumn, all the economic indicators will be still positive and we won't have any hint about recession, then I would say it's a great buying opportunity to buy and hold till the end of this year. But we have to see what will be in the third quarter with economic indicators. At the moment, right now, I consider it as a pullback.
And Brian is asking if you have examples of how to best invest in agriculture.
The agriculture are more easy to forecast. They move than any other commodities or even stocks. And that's why I emphasize on adding agriculture sector to your portfolio. So it's easier to forecast, you will have better winning rate and you will have better risk reward. Some of the markets are considered to be quite thin, but still they follow the basic setups. And I'm talking about different markets. It can be sugar, it can be wheat, orange juice, cattle, and so on. So if you want to diversify with agriculture sector, you have to pay attention to a few tools. First of all, it's cycles, seasonality for some of them, like wheat, for example, valuation modeling, commitment of trader report. It's just amazing tool for agriculture sector, and premium, if any, in the market. Premium is so-called backwardation, but the thing is you don't have just blindly follow the backwardation, but you have to understand the spread. If the spread is developing, it's a great buying opportunity. But if the spread is decreasing, then probably this backwardation is about to end in the market and it's not worth to be engaged in that commodity.
Okay, we have time for one last question. And Let's see. Ron is asking, do you give any consideration to the midterm election pattern?
I didn't run the full forecast yet, so I plan to complete it this weekend. And I have combined 2 cycles of 4. And generally speaking, I expect a bit more weakness the next year. But that is generally speaking, and as I told, it's based on combination of 2 cycles, and I would like to add 2 more to get a better idea about what to expect.
Thank you so much, Ina. That's all the time that we have. I want to thank you so much for taking the time and presenting today. And I want to remind everyone that we will be back here tomorrow at 9:30 Eastern Standard Time. And thank you so much for all your questions. And Ina did have her contact information, so please feel free to reach out to her for more information and to answer the rest of your questions. Thank you, Ina.
Thank you for having me, and thank you everyone for coming.